Well, this week our guest on the KGB interrogation is the CEO of Origin Energy, Grant King. Thanks very much for subjecting yourself to an interrogation by the KGB, Grant.
No, thanks, I look forward to it.
Perhaps we could start with the government's decision to cancel the hot water service subsidies at 5 o'clock on Tuesday. What do you think of that?
Look, I think the broadest answer to the question is that I think there's been a very large amount of subsidies put towards various forms of renewable solar, wind throughout the world. Understandably, people want to see our economy decarbonise. I think with current economic times, governments are looking to balance their budgets and to save money, and I think a lot of those programs throughout the world have been withdrawn. So I don't think there's actually anything hugely unusual about that. As I understand, the program was always to terminate in 2012 anyway.
You're such a diplomat, Grant. Yeah. I mean, Bremer's getting stuck into them, you know.
Well, that's understandable.
What do you think of the fact that they just come out and did it without warning anybody?
That's a bit like companies issuing profit warnings on the day everybody says, why didn't you tell us yesterday? I mean, there is always a day when the piece of information breaks and it always seems like a surprise. New South Wales went through the same process with the, following the change of government in New South Wales, with the withdrawal of subsidies for solar hot water, solar rooftop PVs. But I just think it's part of a broader trend that sees people far more questioning about the level of these subsidies and the, if you like, the public good that's been achieved by them.
Well, do you think in general that renewable energy targets and certificates and all that stuff are an inefficient, expensive way to achieve renewable energy?
Well, in a similar vein, there's been discussion about the Solar Flagships program and the fact that two major projects that were going through the review process in those flagship programs have also not proceeded to finalisation. That was $1 billion program targeting support for two projects, each project receiving around $400 or $500 million of public subsidies. Now, at the end of the day, there'll be a whole series of judgments. People have different views about, as I say, the public good of these things, but that is a lot of money in the current circumstances.
Yeah, we're asking for your view. What do you think?
Look, if I take the two solar flagship ones and if I take solar hot water installations, one of the two programs was really trying to demonstrate something new, something different. It was a thermal solar project. One of them was a solar PV project. In my view, enough money has been put to solar PVs on rooftops not to need to demonstrate that we can also do it in paddocks. And effectively the size of the subsidy simply reflected the different value of electricity in a paddock versus on a rooftop. Wholesale cost of energy versus the delivered cost of energy. And the difference was just a bigger subsidy. So I don't believe one of the projects was demonstrating anything new, and therefore doesn't, in my mind, pass that test of public good in relation to the amount of money that's been invested. Solar hot water systems have been installed throughout Australia for a long time. They're very effective. We provide a lot of solar hot water systems in our business, as we do. I think we're probably the largest installer of solar PVs as well. But we should be moving towards these things being economic in their own right, and solar hot water in particular would be in that category.
If the subsidies are removed or not taken advantage of, what happens to the 2020 target, 20% by 2020?
Yeah. So if I answer that question a little bit in reverse, what happened through 9-10 when there was a very significant state-based move towards feed-in tariffs that essentially overstimulated the solar PV industry? It actually flooded the markets with RECs. And those RECs were very cheap because they were long.
Which stands for Renewable
Energy Certificates, and that's what you have to equip in order to meet your liability under the renewable energy target. So the somewhat ironic situation is the markets are awash with REC certificates, and quitting the target, we would say we're covered through to 2015, 2016 because we have certificates that we bought as part of that process. And I think our competitors would say, certainly AGL I think would say they're also largely covered. So in respect of the RET scheme, broadly the liability is probably covered through to 2015 already. That leads to noise around why aren't we building more things, and the answer is it already got built through all the solar PVs that went on the roof because that part of the industry got overstimulated. So this is an area, and I think we would say, and I think business at Broad would say, there's been too many of these programs sort of thrown in the short term with the view that they would create a broader good, but in aggregate no one's looked how they've all worked together. So the RET target is there for 2020. The issue we take with the RET target is that a lot of that's now going to have to be satisfied through a build probably squashed into 2015-16.
Is it true that the electricity generating companies are going to pay almost $4 billion in carbon tax after the rebates? And if that's true, what effect that's going to have on profits and prices?
So to answer that, let me give you some sort of factual basis for that discussion. At $23 a tonne, and the average carbon intensity of the NEM's about a tonne a megawatt of electricity produced, the number will be big. Those sorts of numbers are true. But in respect of the...
What, 4 billion, is that right?
For example, some of the larger power stations produce 20 million tonnes of carbon a year, so like MacGen or Loy Yang, so 20 million times 20 bucks, $400 million straight away, for just one power station. So it's not hard to get to a number like, 3 or 4 or $5 billion. So I would imagine that's in the ballpark, correct number. Just remembering that for the first 3 years of the scheme, it's a tax. So Bob, in dealing with your question, what happens obviously is you pay $23 a tonne. Everybody will pay $23 a tonne in the first 3 years through to 2015. And the generation sector is the biggest emitter of carbon. It will pay a very significant bill, and that in the normal course would be what ends up on a consumer bill. And that's why I imagine the government has said we'll also adjust tax to try and keep the average consumer roughly whole. And we would broadly agree with their analysis that they will be kept roughly whole. And just to give you a quick, put that in perspective, the $4 or $5 billion is a big number, but the average household uses about 7 megawatt hours of electricity. So 7 times 23 is about 150 bucks. So that's where that sort of household compensation number comes from. So just be a bit careful, because at an industry level, lots of megawatts get generated and it's a very big number. But we only use that, as I say, on average 7 megawatts a year in our home.
For the generators, though, it's a big issue, isn't it? But MacGen has said that it turns them from being a profitable generator to being an unprofitable one instantly, and that there are cash flow issues associated with that.
So let's then go through the phases. What happens is in the initial phase, so when it's implemented on July 1, the scheme, I think, is reasonable in that you incur your liability, but you only pay 75% of it at the year end, and then the balance post that. So you're getting the revenues through the year and you're actually settling that liability. Basically, you presumably pay your tax either through the year or the year end as well. So it's actually okay when you implement it in that fixed price period. 2015 plus, we enter this traded period. So it's not a fixed price anymore. It's not a tax in the literal sense of the word. It's going to be whatever the price will be. And the government is trying to deal with the working capital issues there by quarterly auction of permits. So not making everybody pay up front in one big hit, and having a regular release of permits to smooth the cash flow effects. The issue that the industry is very focused on is, however, that between probably a year or so out in that period in 2015 when it becomes traded, the industry will start to think about how do we bring certainty to our long-term contracting activity, because we'll now also have to attach a carbon, we'll have to equip that carbon liability with our contracting activity. And in that period, we may have to buy permits 2 or 3 years forward, and that is the issue. It's this transitional period. So, on the instant, so the first year, for example, not such a big deal because the government's allowing effectively a settlement at the end of the period. Normal trading beyond 2015, we have a situation where it's quarterly, so you're trying to reduce the working capital impact. But if the industry wants to write long-term contracts that span that transitional period, it could have to outlay very, very large amounts of money to back its contracts. Now, the industry has a choice, and that is not to write long-term contracts and trade almost entirely spot. But that would bring a lot of instability to the industry as well, and that is not the way the industry has historically operated, because, of course, it increases everybody's risk exposure to short-term prices. And that's not the way the national electricity markets worked.
And presumably they could be gamed, so we could see price spikes.
Well, if you entirely have a spot market, you will see the underlying volatility of the market. And the reason we write long-term contracts and hedges so our companies don't blow up if we see underlying volatility. Now, gaming is just a function, gaming is another word for commercial behaviour in the market. I mean, at the end of the day, electricity's been bought and sold now for 10 years in the NEM, and there have been days when it's been $12,500 a megawatt hour. If you have a naked exposure to that, that breaks companies, that breaks retailers, or it breaks generators, counterparties. And that's why we write long-term contracts. So if we have to continue to write those contracts, we need also to hedge the carbon cost. And that's the big issue for the industry. How do we manage through that transition?
You've been warned by Tony Abbott, you and all generators, that the rules will change after the election if he wins.
Yeah.
So that if you have written long-term contracts and you lose by them, then he will declare that your own fault and you must take the loss.
Well, I think, at the end of the day, I respect the political, the policy difference the various political parties have. But at the end of the day, our first obligation is to comply with the law. And the law is, from July 1, we'll have a carbon pricing scheme. Now, as I entirely respect a party's position to say we will change the law, but like every change of law in Australia, they'll have to look at the legacy impact of that on organisations that have complied with it. But if the consequence of that position is to say no one should write long-term contracts or hedge away that risk, then I think we will bring upon our market and our customers a far greater discomfort than is necessary.
I was interested, just taking you back, you said that the $23 a tonne carbon tax from July 1 won't be too bad because of the way it's operating. You have to pay at the end of it end of the year like a tax.
Yeah.
Can you explain that a bit more detail?
Yeah. So we will need, if you operate a power station that's got a carbon liability, you'll need to buy permits to offset that liability. But the settlement of that acquisition of permits will occur at year end. So you pay, I think, 75% at year end, and then the remaining 25%, I think, in a subsequent period. And to the extent that you've been able to, you've already priced through the cost of those permits and the electricity you're selling, so your revenue is ahead of your costs. So that means the working capital impact through that period is minimised, or it certainly should be manageable. Everybody will be exposed to their ability to pass that carbon price on. But of course, that's what a carbon, like it or not, that's what a carbon price does. Some will have more or less ability to pass that carbon price on. But that big working capital effect is ameliorated, somewhat moderated through that initial period because of the deferred settlement.
How do you feel about the ability to pass it on? What's going to determine that?
Yeah. Each entity incurs its own specific liability. It's a phenomena of its own carbon intensity. So a brown coal power station has a much higher carbon intensity than a black coal, than a gas, than a renewable, than a wind farm, which has none. Now, each of those entities will clearly and should act in its own economic interests. It will seek to pass through the cost it's incurring, but the market will determine what that clearing price is, and therefore the ability of everybody to pass it on will depend on, if you like, the clearing price in the electricity market, which is the way the current market currently works. So, if I could just perhaps take 1 second longer to try and explain it better than I might have done.
Well, I'm trying to get a view as to will the companies be able to pass it on?
Yeah. It's in the detail, it's got a lot to do with where it changes every power station in what we call the merit order. So at the moment, brown coal power stations are the cheapest power stations to run, and they're therefore low in the merit order, and they always run. So they're base load and they always run. Now their costs will go up substantially. Their costs will go up by maybe $30 a megawatt hour, $23 a tonne by something like 1.3, and their coal cost is something like $6. So the cash cost will go from $6 to maybe $36. So clearly their position in the merit order will change, and therefore their ability to recover that cost will be different than it was before that cost was incurred. But it does depend on the clearing price in the NEM. It does depend on demand for electricity. When we need all our power stations running, for example, then they should all be able to recover their costs.
But some of them might still be first up in the merit order.
They may well be.
In which case they'll be fine.
That could well be the case.
And might in fact get a cash flow benefit.
For a timing point of view, because we've got these 3 different periods of time, it is actually possible that you might actually have a benefit in that first period. If you're able to fully pass it through and defer the payment, not defer, just the way the system works, you settle up towards the year end, it might actually be a benefit.
How does it affect Origin?
Well, the carbon intensity of our portfolio is much lower than NEM average, so we've got a lot more gas in our portfolio than coal, and the coal in our portfolio is NEM average. Its carbon intensity is about NEM average. So at a sort of simplistic overview level, broadly you'd expect the electricity market to recover its costs at the average intensity of the whole market, and those with intensities less than the market might recover a bit more, and those whose intensity is more might recover a bit less. And that's exactly what should happen, because it should force a change in the merit order, and that's what causes fuel substitution. So that's the way a carbon price is supposed to cause a change in the amount of carbon emissions.
Independently of the carbon price impacts, consumption of electricity has actually been falling for the last 2 or 3 years. Why so?
Yeah, well, there's 2 good points perhaps that can be made in response to that question. Firstly, we think there's a sort of maybe a 3% over 3-year type effect, and it's all happened since 2008. So I think as an industry we feel there's 3 or 4 things packaged up in there. There's probably some economic effect, mainly in what we call the SME segment, so small to medium enterprises. That's where we see as a business that the economic circumstances the last few years have had the biggest effect, the smaller business enterprises. So we think there's some economic effect, particularly in that segment. We think there's some efficiency and price effects coming through, so there have been some pretty substantial increases in electricity prices, and that together with some of the efficiency initiatives is having a bit of an effect. There's clearly, in the back part of that period last year, there's a weather effect. There's no question the weather's been more benign, so effectively we haven't called for as much air conditioning and as much heating, so there's a bit of a weather effect in there. And there's also been a solar substitution effect. So that 9-10 period, again, where a lot of solar rooftop PV was brought into the system, doesn't mean that people are using less energy, but they're of course getting it from a different source. So there's a bit of a solar PV effect in there as well. That comes back to the earlier question you raised about the good of these schemes. People aren't less necessarily, and that's why it's hard to tell whether they're using less energy for efficiency or they're just drawing more energy from sources like solar PVs. So generally those are the 4 areas, but it's very difficult to ascribe a particular proportion of that 3% to any one of those areas. And I think the important other point to say is that having had a mild summer, we really don't know where peak demand is. So if we were to have a hot summer again next year, peak demand may still well be a record peak. And I would actually probably place a bet today and say that come next January, even though average energy consumption is on a bit of a decline, we'll still find that the next peak is probably still a record. Because people are still putting air conditioners in their homes, they're still putting more flat screen TVs and computers, and we're building bigger houses, probably not quite at the rate that we used to. So my bet is when we have that next really hot day, which is probably next year now, we'll probably still see demand for electricity hit a record.
Grant, when do you believe that we are going to really need extra baseload power in the various states? And is gas the only now viable alternative to provide that power when it's required?
Yeah. So that follows from the last question. It's a good question. That little bit of demand moderation as distinct from capacity, in other words, the requirement for energy across a year as distinct from at the peak, continues in our mind to push back the need for baseload generation. So in our view, we probably don't need to see a new baseload power station built in Australia much this side of 2020 towards the end of the decade.
Wow, that's incredible.
Yeah. We will need peak built, and I'll just take you through why that's the case. So essentially there's plenty of energy. There's the ability to generate plenty of energy to meet energy demand. And what that means is that when you take the mandatory effect, and you asked a question previously about the renewable energy target, it so happens that the amount of energy that's necessary to be brought forward by that scheme, in our view, roughly equals the growth in demand for energy through to 2020. So in fact, the primary investment in generation won't be baseload, it will be renewable to meet the mandatory renewable energy target. Just to give you some benchmarks in your mind, we think we're currently something like 10 or 12% of our energy is coming from renewable sources. But it's important to remember that it was 8% just from roughly the Snowy Hydro scheme. So the last 5 or 6 years we've added 4% maybe, and then we've got to add another 8%, twice that much again, in renewable energy to get to that 2020 target. So primarily the major investment in generation will be renewable to meet the 2020 target, which is mandatory, and that sort of crowds out a new baseload investment. But the problem with the renewable energy, most likely wind and solar, and more wind than solar, is that it's what we sort of call somewhat contradictory interruptible baseload. So it just provides energy, but it doesn't provide firm capacity in the system. And so the other form of generation that will probably still require some further build is open cycle generation, to be there when you need it, to provide that capacity on those very hot days. Now, in our view, the state that will soonest need that extra capacity is Queensland, because it's the strongest growing state, particularly in terms of its energy economy. New South Wales doesn't need power for a long time. And I think in Victoria, probably quite a bit depends on what happens around whether there's effectively a capacity withdrawal around Hazelwood as part of this broader carbon policy. If there's capacity withdrawal in Victoria around, say, Hazelwood, it doesn't require another baseload power station to be built because you've got this energy coming from wind, for example, quite a bit of it in Victoria.
Would that replace Hazelwood? That's a lot. I mean,
you need to firm it with open cycle. So, for example...
So we need to build new open cycle?
Yeah. Well, the power station we've just in the process of finishing in Mortlake in Western Victoria is being built in some respects because of that direction of things, that we need more open cycle. And I think an important understanding is that Victoria has historically been an exporter of energy in the national electricity market. It's exported its cheap brown coal generation effectively north. So if someone decides, and Hazelwood goes through this capacity withdrawal process, Victorians won't run out of power, but it will essentially export less to the north. But it will need to have within the state the capacity to make that electricity supply firm, which is why you'll need more open cycle in Victoria to firm. That's if Hazelwood was to be withdrawn. If it's not withdrawn, you just go back to that underlying diagnosis. You just don't need baseload for a long time.
Grant, with the increase in renewables, it means that
So there's no question the blend of 20% renewables will add to power, and you could do the maths because the REC penalty's around $60. So if you had 20% of 60, you're adding maybe $10 or $12 to the, what would it, because it's 20% of, say, the 60 across the whole market. Maybe you're adding $10 to something that should be roughly around $50. Now, to take that through to a consumer level, a consumer pays around about $150 to $200 a unit in their bill for their energy. So at the consumer level, mums and dads and households, and it's a bit like the carbon price coming through, it's not that big. It's $2 to $3 a week, and I'm not disrespectful at all as to every dollar for a consumer, but it's not probably that big a change. But if you're a big consumer, if you're an aluminium smelter, or if you're a big industrial consumer of energy, the price you pay looks a lot more like that wholesale price. So it's much more material for large industrial consumers. And that's where the change will occur, Bob. That's really where I think you're beginning to people say this is quite a material change for us. We're a big manufacturer, a big user.
And this is going to change our industrial base, isn't it? We're going to have to do a lot more work overseas as a result of this.
Look, I can't. When I say I can't, it's not quite as simple to make that statement. I say that in part because the nature of the Australian economy will change. So, and if I could digress to go back to this question about demand and why is demand softening, I could add just one element that might be relevant, a little bit relevant to this discussion, and that is that the other thing we're seeing probably in the last 6 months is a bigger conversation about manufacturing in Australia and whether manufacturing is going to close, and the impact that might have on energy demand as well, because manufacturing uses quite a bit of energy. Now, that's not a GFC type conversation. That's not one that's been happening for 4 years. It's one that's been happening more so in the last 12 and 6 months in particular. And our view of that is that that's more a competitiveness of Australian industry conversation. How competitive can Australian manufacturing be? Now, when we look at that into demand forecasts, we see some erosion there, and that's a little bit to your question, Bob. But we also see growth. So, for example, in Eastern Australia, the LNG projects and the coal mines will probably grow power demand more than it will shrink by virtue of these effects. So across the whole economy, competitiveness issues to me are part of the normal evolution of an economy, from one particular mix to another particular mix. And it's perhaps reflective of the broader Australian story at the moment, that it's actually the resource development that's happening across Australia, but in particular in Queensland, for example, in Eastern Australia. And a lot of that's grid connected, if it sounds a funny term to use, but it's happening where there are electricity transmission assets. So a lot of it's adding to the demand on the grid. In the northwest of Australia, it tends to be more, the generation is built specifically for the projects. And so we sort of see that as being probably not a major change in demand for energy. So Bob, to go back to your question, it's very difficult for us to say what will determine the competitiveness of Australian manufacturing. There are a few industries like aluminium which are extraordinarily energy intensive. But for many, many manufacturing industries, energy is one of a number of input costs. And I couldn't give you an informed comment about the relativity of that change versus the impact of the Australian dollar, for example. And I'd caution against drawing a direct line to energy costs and saying that the linkage is as direct as perhaps you're probably suggesting.
The other dimension to that energy landscape is as the LNG projects in Queensland come on stream, and those in Western Australia, but particularly the ones in Queensland come on stream, including yours, increasingly gas will be priced on an export parity basis. You've been saying recently that, in fact, coal will also shift quite rapidly towards export parity pricing, which is another sort of structural shift in the pricing of energy in Australia. Yeah.
So I'll give you a view how it plays out, and you can agree or disagree with the view. So if we go back to the earlier diagnosis, for reasons largely of RET policy, we don't need any base load before 2020, broadly, maybe 2019, 2020. So we're not going to use gas or coal because we just don't need to build the power stations, right? The role of gas is open cycle to firm the interruptibility that comes with the renewable. Doesn't matter really what the gas price is, because if you look, for example, at our own, say, half-year results, you'll see that those open cycle power stations run maybe 2% of the time or 3% of the time, and they don't use much gas. And in the case, for example, of Mount Stewart, which operates in the same, that's in Queensland, in Townsville, we run that on aviation fuel, very expensive. But it just doesn't matter, because when the market's at peak, power prices of $1,000 or $2,000 or $12,000.
Aviation fuel.
Yeah. So the important thing to understand is that when you're firming that supply, the fuel cost really doesn't matter that much because of the way the market works and the fact that the price spikes. The question then becomes, where is the next big source of energy in Australia beyond 2020? That's the big question. Is it going to be coal? Is it going to be gas? I can say to you at current carbon prices that it's more likely to be coal in the absence of any change, because the $23 does not fundamentally change the relative competitiveness of coal versus gas as a fuel. So on current settings, coal will still play a major role in power generation in Australia for the long term.
In fact, would you say that the next baseload power station, perhaps post 2020, will be coal?
So the one game changer, and the reason I say no, is that if we did sit back and say we want the best of both worlds, we want still to have competitive advantage around our energy, but we want less carbon intensive energy. And you'd expect me to say this in this conversation, but the project we're working on, which is a long-term project, the best resource in our view, next resource available in Australia is hydro in New Guinea, baseload hydro. And technology is moving in a way, if you look around the world, you're seeing some of these more competitive renewable energy resources now being moved, because you can't move the fuel. You can move coal and you can move gas. You can't move wind and you can't move hydro. So you've got to build transmission, and the cost of transmission is changing dramatically with this HVDC technology. So you're seeing in Brazil and Russia and North America now very long transmission lines being built to connect very cost competitive renewable resources. And the vision we have, and Bob perhaps goes back in part to your question, my view is North Queensland, that New Guinea, North Queensland area has an extraordinary opportunity post 2020 to be one of the most competitive energy intensive manufacturing zones in the world off relatively cheap baseload hydro. And it's an extraordinary opportunity if that was to be developed. So that's a sort of 2020 plus view.
What a fantastic vision on which to end it, Grant.
So we can keep our manufacturing and we can keep our aluminium.
In North Queensland?
But it will need to move, yeah.
Fascinating. Thanks very much.
Thank you.